You're listening to The Pilot's Portfolio, formerly called the Pilot Money Podcast. To learn more about the name change, join us in Season 2.
The One Big Beautiful Bill Act, you might have heard of it. Earlier this year, Congress passed and the president signed into law a new reconciliation bill. And it's huge. It covers a lot of ground. One thing that it addresses new tax legislation. And earlier in the year, you'll recall on the show, we said, hey, we expect some changes in tax law. We will keep them on our radar and let you know when they come and how that may impact you. So they're here. So that is one thing that the OBBBA, or One Big Beautiful Bill Act, discusses. And then something else that it addresses that I know every listener on this show will be grateful for is more funding for the FAA, primarily to improve safety and efficiency to modernize the FAA. So we appreciate that. In today's show, we're going to talk about some of the changes that this bill has and its impact on your bottom line.
You're listening to The Pilot's Portfolio, the show dedicated to guiding professional pilots towards a future of financial success and stability. Fly along with your host, Timothy P. Pope, as he provides financial planning insights and answers to your burning questions and dives into real-life stories from fellow pilots who share their successes and cautionary tales. The Pilot's Portfolio takes off now.
Welcome to Pilot's Portfolio, everybody. My name is Timothy P. Pope. I'm a certified financial planner specializing in the planning needs of the professional pilot. In our last episode, we talked about the disability comparison chart. So we're still working on that. I expect us to get that out sometime soon, within the next month or so. We'll announce that when it's ready. And then also, we love your questions. So if you have a financial question that you'd like to hear our thoughts on, send us an email, info@pilotsportfolio.com. And your question may be featured on an upcoming episode in Pilot's Portfolio. So let's jump to today's topic, which is looking at some of the changes in this One Big Beautiful Bill Act. And I know as professional pilots that tax planning is near and dear to your heart, because a large part of you guys are W-2, solely W-2 earners and high income earners there. That means your wages typically they are what they are. And in terms of creating deductions on that total income, the tool basket may be limited in a lot of cases. And since 2018, the standard deduction was increased so much so that for many people, they take the standard deduction, and that works for a lot of families. But we often are talking about how to lower your tax bill with our clients, and sometimes the things that you can do are directly in your control, and sometimes it's less obvious on how to be tax efficient. So let's talk about some of the changes that you can expect in 2025 and moving forward in this new bill. So number one, this is actually not a change, and this is welcome news. It's tax brackets are staying the same. Okay. Now, this is a big sigh of relief, especially for high income earners, because if the Tax Cuts and Jobs Act had expired the way that it was scheduled to, then that means the brackets would have went back to pre-2017 bracket. There were 7 brackets at the time, different than what they are now. And particularly the highest bracket was 39.6%. Okay. That's way too high, in my opinion. That's way too high. The top bracket is going to remain at 37%, still high, right? But currently what we have is the 10th, the 12th, the 22nd, 24th, 35th, and 37th, okay? And then starting in 2026, they'll be adjusted by inflation each year. So the brackets are staying the same, which that is good news. We also have a slightly higher standard deduction. Again, since 2018, the standard deduction increased by a lot for a lot of families. And this year it was scheduled to be $30,000 if you were married jointly. But now it's if you're married filing jointly or you're a qualifying surviving spouse. So if you lost your spouse recently, your standard deduction is $31,500. If you're single or married filing separately, your standard deduction is $15,750. And if you file as head of household, your standard deduction will be $23,625. Okay. So the way your standard deduction works is you add up all your income from all the sources, wage, pension, investment income, and so on. And then either you take the standard deduction, which the numbers I just read, or if you itemize, and typically you'll itemize if you can get a larger deduction there. So you either take the standard deduction or you itemize, and that's going to lower your total taxable income. So higher standard deduction is what we can expect from this bill in 2025 and moving forward. Let's see here, more SALT. It's not more sodium, that is salt, increased SALT. That's what that note should be. Increased state and local tax deduction is what we can expect. So if you follow the process, this deduction, the state and local tax deduction, was hard fought, and particularly from states with high income tax. So we think about California and New York, New Jersey, places like that. What this allows you to do, if you live in a state with a high income tax, this could be valuable. Previously, this deduction was limited to $10,000. Now it's increased to $40,000. So if you itemize, you can get a deduction for your property tax, your state income tax, your state tax on personal property, and so on. And it's going to be valued at a $40,000 deduction. That amount is going to be adjusted by 1% until 2029. And then that state and local tax deduction is go back down to $10,000. So we've got an increase state and local tax deduction there. There is a catch though. If you're married filing jointly and your adjusted gross income is $500,000, or if you're married filing separately and your adjusted gross income is $250,000, this state and local tax deduction starts to phase out at those points of AGI. That's something to know and be aware of. And I think a use case here when you think about this is there are some tools that we have to lower our AGI. So if you are coming up, if you're planning to itemize and you're coming up on the AGI threshold, and we're seeing that, well, because your AGI is exceeding the limits, you may not have all of this state and local tax deduction available to you. One of the tools that you have in your toolbox is the 401k contribution. You could do pre-tax contributions there, lower that AGI, and then, land on the right side of this phase out limit. And then that would allow this $40,000 deduction to be available to you. So you got the 401k you could do that with. If you're in a high deductible health plan, you have the HSA, you could cobble together deductions like the charitable contribution that we'll talk about in just a moment, right? So I think this is one of those areas where if you're just looking at a 401k deduction or an HSA deduction or the charitable deduction by themselves, they may not make a huge difference. But because they're related to other aspects of the tax code, when you work them together, that's where their value really shows up. So unfortunately, our tax code is complicated, right? And there's several moving parts. And so it certainly makes sense to kind of stay abreast of them or work with somebody who is. So we talked about state and local tax deductions there. Let's also talk about charitable deductions for taxpayers that are not itemizing. So like I said, with the expanded standard deduction, a lot of people are not itemizing. And what that did was, well, if you're not itemizing, then you're not really getting deductions for any charitable contributions that you're making. And so this bill does allow a small charitable deduction for those that are not itemizing. So if you're single, that's $1,000. If you're married filing jointly, that's $2,000. So if you're charitably inclined, I say, look, if you're going to give the money away anyway, you might as well get the credit for it. And as I mentioned before, when we're talking about the SALT deduction or the state and local tax deduction, all of these can add up to work on your AGI there. So you've got some charitable contributions if you're not itemizing.
Hey, pilot, are you looking to save 20% on the sale or purchase of your next home? Let me tell you about a friend of the show, Beacon Relocation. With Beacon's exclusive real estate benefit, you can save thousands. My family has actually used their services when we needed to sell a property that was multiple states away. Beacon has over 1,500 experienced agents providing outstanding service and expertise as they guide you through every step of the buying or selling process. They'll even connect you with a national lender who offers competitive rates and discounted programs. As a Pilot's Portfolio listener, you are eligible to receive 20% of the real estate agent's commission towards your closing cost on the sale or purchase of your home. Visit beaconrelocation.com today. Select Pilot's Portfolio via the Apply Now drop-down menu to activate your benefits and make your next move your best move.
Buyer credit varies in some states. Contact us for details.
Let's talk about credit. So the child tax credit. So if you have children that at the end of the year are going to be under the age of 17, your child tax credit is going to increase from $2,000 per child to $2,200 per child. So you get an extra $200 there. And then AGI limits do apply. So if you're married filing jointly, it's like $400,000 before that starts to phase out. So we have a small increase on the child tax credit. We can pause and just talk about the differences between a credit and a deduction, just so everybody's aware. A credit is going to wipe away the amount of tax that you owe dollar for dollar. We love credits. For example's sake here, if I owe $2,200 in federal tax and I'm also eligible for the child tax credit, well, then that credit is going to wipe out the tax liability dollar for dollar, and I'm not going to have to pay anything. So credits are valuable and they are dollar for dollar. A deduction, on the other hand, works differently. So let's say that my taxable income is $100,000. And that means that on the first bit, I'm going to be taxed at 10%. And then once I fill that bracket up, the next part of my taxable income is going to be taxed at 12%. And then finally, there's going to be a small portion that's going to be taxed at 22%. In the case of a deduction, if I had a $10,000 deduction, then that means instead of my taxable income being $100,000, now it's $90,000. And then I would fill those brackets up and I would pay whatever the appropriate tax bracket is on those dollars that are in that bracket. Okay. So the deduction, it doesn't remove my tax liability dollar for dollar like a credit does. And in the example I just gave, it's more like you need $4.50 of deductions to reduce your tax liability by $1. So the higher the tax bracket you're in, so if you're in the 35th percent, the 37%, you're going to see a bigger bang for your buck with deductions than say you would if you're in the 10, the 12, or the 22. That's the difference between the two. And I think let's apply that here. Let's talk about this next deduction. Okay. So this bill wants to encourage manufacturing at home. It wants to encourage us Americans buying more here at home. And so this deduction, starting in 2025, is you can deduct up to $10,000 of interest on a new car that was assembled in the U.S. I like that we're focused on manufacturing at home. And I think, wow, if we do more manufacturing at home and use our ingenuity to also keep prices the same, that it will be a win-win for everybody. But I'm bracing myself so I can hear this now, right? So like, hey, maybe I ought to go buy a new car and finance it because I'm going to save on taxes. Like, well, not so fast. Yes, you may get a tax deduction on the interest that you have paid the bank, but you're still paying the interest to the bank. And we just talked about how deductions are not dollar for dollar. That's not reducing your tax liability dollar for dollar. And on top of that, because you bought a brand new car, you are also buying a depreciating asset, or an asset depreciates really quickly as you drive that thing off the lot. So look, I love new cars. I just like when you buy them cash, right? And if we're not buying the new car cash, then hey, maybe somebody else takes the depreciation and we buy something that is almost new, but somebody else took that immediate depreciating asset. Now, of course, if you have a business that you need to buy cars and equipment with, and you're also going to get 100% depreciation on the equipment that you buy, then that's a completely different story. But here we're talking about consumers and a use asset and this $10,000 interest deduction that is available now in this bill. The last thing that I want to talk about is 529s, and I'm a little disappointed that it is last in the list because it is so valuable. I mean, I talked to a lot of parents, some who love the 529, some who question like, hey, is this account type really all that it's cracked up to be? I feel limited or restricted. I'm not even sure if my child is going to go to college. Well, I will tell you, the 529 has just gotten better and better as time has gone on. The 529 is an investment account that's designed to pay for your kids' education, right? We can think about the 529 like a Roth IRA for education, which means we put after-tax money in it, and then the earnings grow tax-free as long as we use it for qualifying education expenses. Some states will actually offer a state income tax deduction for contributions to a 529. So starting in 2017, the 529, we're able to use $10,000 per year for K through 12 education benefits. Now, starting in 2026, that is going to be $20,000 per year. So now it doesn't have to only be for college. We can use it for K through 12. So we can think about private school and so charter school, homeschool expenses, things like that. Also, you'll be able to use it for, the student will be able to use it for vocational school, licensing programs, tutoring. And so it's really expanded to be an all education account, if you will. And then the Secure Act of 2022, that allowed us to roll over $35,000 to a Roth IRA as long as the account's been open for 15 years and the beneficiary has earned income. Okay, so that's another powerful thing. So, you think about this, like $35,000 you can roll into a Roth IRA. The day that your baby's born, you put in $7,500. Let's say that you invested in an index fund that's going to get, maybe it's 100% stock. And let's say we're going to assume a 9% rate of return there. So in 18 years, the child is going to have $35,378. So, hey, that's not bad to seed the 529. Let's say only if we wanted to use it for the Roth rollover feature. But I think with it becoming a more flexible account, that there's so many other options to use it. The vocational school, the licensing, the tutoring, and so for the K through 12 expenses and so on. So if anybody's thinking about making a maximum lump sum contribution to a 529, you could do $19,000 per student, per beneficiary. So if you're married, friend, and jointly, you can contribute $38,000 in 2025. And you can also front load the contribution for 5 years. So that means you could do $190,000 per beneficiary or student. But if you do that, then you're not able to make another contribution for that beneficiary for 5 years. So you could stay within the annual gift tax exclusion. And so if your parents are thinking about making a contribution to their grandkids' education, a lump sum 529 contribution may be a great way to go. So I would say this, because this new legislation is a federal law, just keep in mind that states are going to have to choose to align their rules, their laws with the federal law. And so I would just check to see what your state's rules are about the 529 distributions. But we could expect probably a lot of states will align, but there's always a few that have some carve-outs. So with that, we went over a lot in terms of what is staying the same and what is changing with the OBBBA, the One Big Beautiful Bill Act. And I'd say this, check your financial plan, check your investment plan to see how these tax changes or what's staying the same has an influence. And there's so much more in the bill than just taxes, right? There's estate things that have stayed the same as well. There's a sigh of relief for people with large estates. And there's other features. So we'll continue to bring these out and talk about them as time goes on. But that's going to do it for this episode. Thanks for joining. Send us your questions, info@pilotsportfolio.com, and we'll see you on the next one.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a Pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors, 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a Pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors. 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.